As you would have noticed, I've tried to summarize the current situation in financial markets in three R words: recoveries, recessions, and ramifications. I think the three form a very good cocktail of what we are seeing, what we have experiencing, and what we probably will experience in the months ahead. Um, you know the drill, I'm assuming. I'm more than willing to share my views, my insights, my research, and those of others, because as a journalist, I can sometimes quote and rely on others. But I don't know you. You might know me, but I definitely do not know you. So nothing I can say today, it can be construed as financial advice. If you think I do, you must have misunderstood me. Otherwise, I hope you will enjoy today's presentation. That goes for both of us. Now, I'm going to talk today a lot of bad things. There will be some positives as well, but there will definitely be some bad things as well. We always like to think that the share market should always be good news. I think one of the things that FN Arena brings to the table is that we don't think we should shy away from telling it as it is. And at the moment, whether it's a bear market, a bull market, it sort of depends on what narrative we follow, where we put our focus, because it's a very polarized equities market globally. Equities being polarized means we can just pick whatever we want and then make that our narrative. Very simple observation. At the index level in Australia, there have been hardly any gains year to date, and it would appear that equity markets at the index level are going sideways within a range. Whether that's good news or bad news, again, depends on one's angle. But I think the most important thing to realize here is that, in particular in finance, this too shall pass eventually. Nothing remains in place forever and ever. And as investors, that is good to keep in mind, because it applies both in the good times and in the not so good times. Now, coming out of 2020, the lockdowns, 2021 as well, we've had the recoveries, but unfortunately, that also brought with it inflation. And inflation really has changed the dynamics in financial assets. We all experienced that. As we can see here on this chart from Westpac, inflation hasn't been this high in decades. The black line is the headline inflation. The red line is the so-called core inflation. They're both well above levels we have seen for many years. We have to go back to the early 80s to see this level. Central bankers have moved first very hesitantly and then very quickly in trying to rein it in. And at this point in time, we still have central bankers tightening, raising interest rates, because inflation, it is coming down, but it's probably not as fast as we all would like to see it. Now, this, of course, has determined the overall environment for risk assets. Bonds had to reset, equity markets had to reset. It doesn't affect all the equities to the same extent, but it does affect. And at this point in time, unfortunately, as I have been predicting last year as well, I'm afraid that this is a long, elongated, gradual process. It really wears one down if you're really waiting for the end of it. And unfortunately, there's just no way of speeding it up. It is what it is. And we will just have to get through this. And unfortunately, as I said earlier, for those who would have hoped that inflation would be lower by here and that central bankers could be thinking about no longer raising interest rates, we're not at that point yet. We will get to that point at some stage, of course. But at this point in time, it's fair to say that Australia, Canada, Europe, United States, all those central bankers, they're still looking to further increase interest rates. And of course, that has ramifications. As we can see here, and I'm going to move myself a little bit higher so I'm not interfering here. History shows that bond yields, they correctly anticipate the tightening process that's coming, but they also start anticipating what comes next. And what you will see is that the black line are the bond yields, the more yellowy line is what the central bank, in this case, the Federal Reserve in the US does. And you will find that bond yields peak before the central bank does. And that is usually the case. This case is not different. Bond yields have already peaked. That happened about late last year. And that is because the market is always forward-looking, and the bond market has had no hesitation in first sort of predicting that the tightening cycle would go a lot higher than where we would go previously. But also that now we will probably see a significant slowdown in economic growth in the US. Whether that will end up with a technical recession or not, again, it hinges on what's your exact definition. It hinges on the exact timing, etc. But it's fair to say that bond yields probably will not be higher in a year's time or even in 6 months' time. This already has had consequences in share markets. If anyone wonders why the share prices of the likes of REA Group or WiseTech Global or Technology One or even the CSL in Australia and the technology stocks in the United States, why they have performed so well in 2023, look at the bond market. That basically was the sign for those, because that type of stocks is particularly affected by rising bond yields. So bond yields come down, you get a rally on the other end. We are not finished yet, but as far as the bond market is, we are now looking towards an economic slowdown that may or may not involve economic recession. I personally think that the emphasis on recession, yes or no, is a bit tedious. I think the main message is we will get an economic slowdown, because that eventually is the ramification of having a tightening cycle that is amongst the fiercest that we've ever witnessed in history, and definitely in our lifetime. Now, the share market and share markets in general have proven pretty resilient this year, and that's probably putting it mildly. Although not everything is necessarily the way that it looks like, because the index is not necessarily reflective of what happens underneath the index. The other thing also is important. What happens in the share market is not necessarily reflecting what happens in the economy. And one of the reasons that it's very obvious to make that point is that there's now a lot of doubt whether we will see a recession, for example, in the US, because this process is taking so long. But if you look in the economy, and this is, for example, this is one example that's the obvious point to make. If you look at the numbers of bankruptcy filings in the US, it's now on course to potentially exceed the number of bankruptcy filings that happened during the GFC. So that gives you a little bit of an idea what's happening in the United States underneath the surface, outside of the share market. So it does have consequences. It just hasn't had consequences in terms of further weakness for US equities at the index level. Because if everyone who has been paying attention this year knows that the majority of share prices in the US is down for the year. There's only a very small number of stocks that is responsible for all the index gains, and we will talk a little bit about that later, why that is. Bond yield is only one small piece of the puzzle. Another consequence that we've seen in the US is that we have another banking crisis. A lot of economists are a little bit hesitant in using the word crisis, but I think we can use the word crisis. We have a banking crisis on our hands. Maybe important to point out here that what is happening in US banks is not necessarily unexpected from a central bank point of view. From the moment that you have exceptionally low interest rates and bond yields, and you get that quick reversal through a very sharp tightening by the central bank, you will run into problems in the banking sector. That is almost by definition a given. It's just the question is, can they contain what is happening, and can they prevent it from becoming a much larger problem? So far, that answer might well be positive, but it doesn't mean that we will not have further ramifications. Apart from having some regional banks going belly up, I think the main message that we should take away from here is that credit will be restricted in the United States. That was already happening for 12 months or so. It will now go even further. And adding to the general question whether the US might or might not have a recession later this year or early next year, history suggests that while in economies in Europe, in Australia, most recessions occur when consumer spending, where basically consumers stop spending. In the United States, history shows that most recessions happen when credit is tightening. Credit is tightening now in acceleration because of the banking problems they are experiencing, which all else being equal means the odds have further improved that we will have a recession later this year. If anyone wants to do some more research from a historical point of view, I would recommend doing some reading on the savings and loans crisis the US had in the second half of the 80s and the first half of the 90s. And that lasted for years. That wasn't over in a quick time. But it doesn't mean that the whole share market has to be weighed down by it, of course. It just means that certain sectors of the market will have a higher risk profile. Now, as I already pointed out earlier, the US economy, recession or not recession, is usually in direct correlation to credit. And the analyst at the Macro Compass in the US has put a few nice charts together. It basically implies that if credit keeps on falling, which at the moment it is, ultimately earnings per share for US companies will follow as well. And that's obviously the shoe that is yet to drop in the US, although we've had negative EPS growth in the US for the past year. There is still a lively debate going on whether there should be more falls to be expected or not. If the answer is yes, more than likely we should see lower share prices. Why do we have a debate? We have a debate because the process so far has been very, very slow, gradual, very elongated, and there is still no clear uniformity in indicators, forward-looking or otherwise. And while I've just pointed out a few items, a few factors that would suggest that we still have a lot more bad news in front of us. This is an indicator by the St. Louis Federal Reserve, and their indicator, which is supposedly measuring stress, financial stress in the US economy. They are not measuring any stress, which suggests that the Federal Reserve can continue tightening and without causing too much problem for the US economy. It is a bit of a give and take. As every economist will tell you, indicators never go in one direction. They never point into one direction. It becomes a little bit of which narrative do you want to focus on? Central bankers, of course, apart from tightening, they are very well aware that we are in that the conditions are different these days. We have much more debt and leverage in our systems. They have to be a little bit more careful. They can't just repeat the 1980s. Even though in the 1980s, of course, we did get recessions through tightening. But this time, the financial system at times is much more vulnerable. Central bankers have responded by managing liquidity in the system. And at times, they have added more liquidity, and that has supported the share market, for example, and other markets as well. Now, liquidity, that is a little bit of a different animal. Like, we're all very adept in keeping an eye out for unemployment rates and maybe for credits. and for manufacturing indices and etc. But liquidity, that's much more difficult to measure. There are a few people around in the world. They're very specialized, and usually their information is only available at the wholesale level. It's also that whatever is available comes with a delay. But we might have one indicator available to all of us, and the recent years have shown that Bitcoin in particular tends to move upwards and downwards in line with the general liquidity in the system. And you can see here that when liquidity was very much plentiful in the system, Bitcoin had wonderful days, and it was, according to some estimates, only but a matter of time to be on its way to $100,000 per coin. Since the central bankers started tightening, we've seen that deflate quite quickly. And then one of the things that is very noticeable is that towards the end of last year, when equities were looking like they were really in the doldrums and Bitcoin was going nowhere, all of a sudden at the beginning of the year, both started moving. And that is, we know in hindsight now, that was, amongst other things, the Federal Reserve injecting new liquidity in the system. And it worked, right? Equities went up, and in particular, central bankers know that's how the human nature works. If share prices go up, we all feel a little bit better. We might buy some shares ourselves. If share prices go down and stay down, we all get a little bit depressed about it. So it works when they inject some extra liquidity in the system. The problem, of course, is that can they keep doing that, and can they keep getting the same results? In the same respect, they don't want share markets to be too positive, because it sort of interferes with their strategy, with their policy of reining in inflation, and share markets cannot be rallying to the upside to achieve that goal. I said earlier, we are still in a phase when there's more tightening coming, and I'm definitely not the only one who will make that forecast, and I think that's a fair forecast to make here. One of the reasons why at least parts in the share market are looking forward to what's coming next is that at one point, exact timing unknown, but there comes a point when, of course, when central banks will pause, they will no longer raise interest rates. And then there comes a point, usually history shows a few months down the track, they start reducing, they start cutting interest rates. Now, we all know, we've experienced now how the whole tightening process has kept a lid on risk assets, roughly taken. So there is an expectation that from the moment that central bankers are no longer keeping the lid on the markets, that we will have rallies. And that may well be the case. But history shows also something else, that from the moment that the central bankers subsequently start cutting interest rates, that is usually bad news for share markets. And this is what this chart essentially is showing. Every time we see the central banks start cutting, we get quite some downside in markets. And why is that? Because at first it seems contradictory, but it actually isn't, because the reason why central bankers start cutting interest rates is because the consequences from the previous tightening is coming through. That means economy is in trouble. And the market knows that from the moment interest rates start getting lower, it takes a while before that effect to come through, just like it does on the other end when they start tightening. So at first, we get bad news, and at first, share markets will have to go lower. It's a bit of a case of be careful to get too bullish in the short term, and be careful what you wish for as well. Overall, though, looking over the whole process, and we're now about 1.5 years in it, it's only fair to say that even though we went through periods of extreme volatility, as sometimes happens in markets, overall share markets have surprised to the upside. There's no doubt about that. They have remained far more resilient than at times historical precedents would have suggested. And in the same respect, this has made quite a number of people very uncomfortable with share markets. And we don't really know why share markets have remained more resilient than many would have thought they would. But one of the elements of illustrating that is through the equity risk premium, which is what this chart basically tries to do. And without concentrating too much on this, but in very simplistic terms, the risk premium is exceptionally low this year. And if it were going back to where it was previously, we should probably think in share markets being down by 15 to 20% at the least. It hasn't happened, and we don't really know why. And now we can all speculate about, but if we don't know why it hasn't happened, we also don't know whether it will change and when exactly that will happen. I just want to make that point because, again, you pick your narrative, and I know this is the reason why some people are uncomfortable with where US equities are, but at the same respect, we don't know whether or when a further readjustment might happen, and maybe it happens very, very far into the future. We have no idea. We can but speculate at this point. Now, one of the more remarkable observations that we can make about markets, and I'm pretty certain this will surprise many amongst you. From 12 months ago, measured from May to May, from last year until this year, the US share market has essentially not moved. It's pretty unchanged. What has moved is money by institutions. So professional fund managers and asset managers, they have consistently been selling their exposure to US equities. And that's the yellow line you see here. That's quite remarkable, because normally you would think if those guys are moving more money in cash and in recent times more on alternative assets and in fixed income, because bonds are back, then obviously someone else has to be on the buying side. And it turns out that the buyers have been hedge funds, retail investors, and whoever has been buying index products in modern times that involves a lot of ETFs. Again, whether that's good news or bad news, what actually this means, I'll leave that to everyone else to speculate about this. But needless to say, as I said earlier, not everyone is convinced that the resilience we've seen so far in equities, that's a good sign. And not everyone is comfortable with where equities actually are, considering that this is a long and drawn out process and there might still be a lot more coming. In Australia, though, we seldom talk about a recession. It's sort of coming up because the RBA keeps on tightening and is now going beyond where at least a substantial part of the economists thought they would go. They're moving beyond that, and we've been talking about this for quite a while. But the so-called mortgage cliff in Australia is only now opening up. It's very fresh. We knew it was coming, and what this chart shows is that the number of fixed interest mortgages in Australia that needs to be refinanced. This was sort of the level that we had previously, and you see it now picking up, and it goes very, very high over the next few months. The general expectation is that this will have an impact on household spending in Australia. I couldn't help but noticing that over the past few weeks, we have seen a number of profit warnings hitting the Australian share market, usually from small cap retailers. But this might be the early sign that the refinancing of those mortgages that is having an impact at the moment. Surveys and research done by CommSec, CommBank, the largest bank of Australia, as again suggesting that when it comes to spending in Australia, we have a very bifurcated situation where the younger population is now under stress, and they are also most likely to have mortgages as well. And the 50-plussers, the baby boomers, they don't have mortgages. They're usually well off. They're in good position, and they are the ones at the moment still go on holidays and spending. So the question now is, how long will this situation last, and will that be enough to keep the economy out of recession, or will that be enough to at some point prevent the RBA from tightening further? That is obviously something we will have to see, and it's very much related to whether inflation will come down quicker or much slower. An oft used expression in this context is that these things go very gradually and slowly until they all of a sudden accelerate. And at this point in time, it's only fair to say that acceleration, if that comes, it is to show up in numbers and in data. Again, as I said earlier, where there's no uniformity in indicators, and also regarding household spending, for example. Some analysts believe, some economists and analysts believe that consumer spending in Australia is likely to surprise to the upside. In other words, it will prove more resilient than some of the more negative forecasts out there. One of the interesting observations made by ANZ Bank here is the household savings rate in Australia. And in very quick term, because this is an international phenomenon as well, we had our savings rate, which was relatively stable pre-COVID. Then during COVID, we get a lot of stimulus from governments. So on average, there was a lot of savings. Essentially, what has happened, this is one of the reasons why spending has held up so well, is that consumers, both here and in the US and in Europe, have been running down their savings rate. And it's now at a level which is pretty similar to pre-COVID. So now the big question that is hanging in front of these markets and in front of these economies is, now that consumers, on average, in general, have spent the surplus they had left from the COVID and the lockdowns and from the stimulus, are they now deciding to continue going into their savings, or are they deciding maybe now it's time to hold back a little bit and to be a little bit more careful? And the outcome of that question will very much determine the year ahead in terms of economic growth, consumer spending, profit warnings, and further interest rate hikes. Another narrative which I thought was very, very interesting, and again, this one is from ANZ as well. The black line is what we spend on essentials, and you can see there is essentially a small dip in 2020, but the line has continued. And then there's the non-essentials, the travels, the gyms, the tourism, everything you can think of, going fishing on a boat or not. We couldn't do it during the lockdowns, and once you got out of lockdowns, we went well above trend. Now, of course, for how long will we continue what some economists have adopted, revenge spending? And if only we go back to trend, that the difference will be quite noticed by companies in that sector and by the economy in general. So again, the outcome of this, and I'm assuming that we will at some stage, we will hold back a little bit more on our travels and everything we couldn't do while we were in lockdowns. Now, the share market, of course, ultimately, we can talk about forward-looking indicators for consumer spending, tightening economies, etc., etc. But ultimately, it's all about the companies, the health of companies, and how much profits and cash flows they generate. Now, so far, and that's only fair to say, irrespective of forecasts being made that we would by now be in a situation where corporate profits would have fallen by more, that hasn't happened to date. And even though we're now seeing some profit warnings coming through, on average, forecasts are still relatively high from a historical perspective. And then obviously the question is, should they go lower? Should they not go lower? Now, that's a question that will be answered in the months ahead. Forecasts in Australia are falling, still in the downtrend. And what we had in February is quite still. It wasn't a fantastic reporting season. It actually wasn't, but also it wasn't that bad. The only thing that happened in February is that we had a big rally in January. The February reporting season, and particularly locally, sort of proved that that rally was overdone. Companies were not in such a great shape, but they were quite resilient. And these three graphs here sort of like summarize what happened in February. What we saw is that on the left-hand side, sales surprised more than they disappointed, and that's of course because inflation kicked in, and inflation pushes up sales. Inflation, however, also raises costs. Sorry for that. And so what we saw in February is that we had more disappointments on the profit level than we had surprises on the profit level. When it comes to dividends, the difference wasn't that much. It was pretty stable, and that's of course typically Australia. When you have to sell bad news to shareholders, at the very least you're going to increase your dividends or you're going to keep them stable. Dividends don't really tell you much about the future. The other two elements, unfortunately, might give us more of an indication. I think for August we should be prepared that we might see more surprises on the sales level because we still have inflation, but costs, I think costs is what is dogging local companies, and is one of the reasons why we should be careful for the reporting season that's yet upcoming and for the time in between. One of the other things that has surprised many, in particular in the value segment of the market, those experts who would like to buy cheap stocks, is that historically when we have a big gap between the growth and the high multiple stocks in the market, which is the darker line here, the lighter green is the value side, the cyclicals, the banks, etc. Now, historically, when that deflates, they really come back and they converge together. That has not happened this time. This time, the gap has pretty much remained, and that has surprised many who thought a new era for value investing has started. I will have partially the answers for this a little bit further in this presentation. And one of the elements which I pointed out earlier is that bond yields continue to play a very particular role in this, and they continue supporting this side of the market. Also because if we are preparing for a recession in the US and potentially in other economies, then the irony is that the value side is on the operational side much more vulnerable to negative economic growth than is this part. So this makes sense from that perspective as well. Some people are getting very, very itchy and very, very worried that the technology stocks in the US, which again are outperforming just about anything else this year, that is getting a little bit hazy and close to the sun in an Icarus way. At face value, that is a fair observation to make. Historically, as you can see here, if the gap between technology stocks and the rest of the market is as high as it is today, that usually has portended a very bad news for technology stocks in general, like in a fall off the cliff manner. I'm not so sure whether that is this time the case. I'm actually inclined to think it is not, which does not mean, of course, that in the short term, the market at that point, at that particular segment, looks a little bit bloated and exuberant. But I do think that there are potentially reasons to support, again, much higher valuations for long duration assets and for growth stocks. The polarization I've pointed out a little bit, but another way of looking at it is this is something that we recently launched at F1 Arena. Every Saturday we publish an overview of what the several segments of the market have done so far. It's for free, so if anyone is interested, every Saturday on the website, and you can have your own little view. A lot of debate has been going on that there's a discrepancy between what the bond market is indicating, recession, and the share market being very positive, therefore ignoring what the bond market is saying. But it's actually not true on my observation. And this little overview will show you that, because what you see here in Australia, this is year to date, so starting 1st of January and ending last Saturday. You see that here the communication services has performed really, really well. You see the IT stocks have performed really well. Industrial performed really well. And you see, again, technology and gold have performed really, really well this year. These are the outperformers. Those are also typically add discretionary to it. Add the staples to it. Those are also typically the more conservative, defensive, the stocks that you would choose to have in your portfolio if you're worried about economic growth further down the track. What are the stocks that you prefer not to have a portfolio, or at least you go underweight? They are energy, one of the worst performers for the year, still negative. They are not necessarily all financials, but definitely the banks, and the banks are the worst performing sector this year in the share market. You don't want materials, because that's also economic growth, and there you have your metals and mining. So what looks at face value that the share market is actually ignoring the bond market actually isn't. Both are basically in line. The share market has been smart enough to in line with the bond market to choose those assets that you want when economic growth starts disappointing. And you see that the polarization, you see that happening at other ends. I mean, the Japanese share market is back at the highest point in more than 3 decades. They've had a long wait. Yes, there is a direct connection to technology. There's also a direct connection to a weaker yen, but clearly it does stand out. This is based on a very low, small group of companies in the US, of course, and you see that, for example, the Dow Jones hasn't done anything year to date, in contrast to the other major indices. When we go to the commodities markets, as I said earlier, oil is one of the worst performers this year. You see gold and uranium positive for the year. Again, these are not in direct correlation to economic growth. The other ones are silver, slightly negative, copper, slightly negative, but other commodities are significantly negative. And that, of course, is the world being worried about what comes next on the back of very much tightening by central bankers. Now, there was some bad news linked to this. I could easily point out, and which I have, that there's huge segments in the Australian share market that haven't moved in terms of share prices, that haven't moved for a year, 2 years, sometimes 3 years. So which basically means that if you bought the shares 3 years ago, you would be at the same level today, and you would be lucky if in the meantime you would have had some dividends. Here was some research done by Longview that if that happens with typical the cyclicals in the market, that usually portends bad news down the track. And there are some historical precedents, and usually what that means is that next thing happens is that you will go down. That sector is basically waiting to have its Wile E. Coyote moment, as one might say. It all makes sense that with a disappointing China economy this year, and with economies like Europe and US, UK potentially suffering recession, it makes sense that sector might still have more weakness ahead of itself. There's no guarantees in life, but it does make sense from that perspective. Now, elsewhere in the local share market, if we move out of the typical cyclicals, then we have what we've seen since we went out of lockdowns is we've had a reversal of dynamics. So previously we had the COVID winners, and we had companies that had a humongous boost because societies went into lockdown and we had a global pandemic. And we have to think about, I've put a few up here, but like for Ansell, of course, they make the gloves and the protective equipment. Healy's and Sonic, they did the testing. Fisher and Paykel Healthcare, they helped people with apparatus to breathe when they got COVID. And then we all started shopping from home. So the likes of Coke and Redbubble, they had tremendous momentum coming towards them. Now that has completely reversed, and you can see that also in the share price of those companies. Now, for those companies, and for the likes of Redbubble, there's actually a question whether they actually have a business model that could ever be profitable. But the question here is, how long will it take before they can come back to more normal operations? And that might actually take another 6 months, maybe 12. So investors will be waiting for a reversal again back to normal there. But first became the negative, of course. On the other end, we have a lot of companies that were negatively impacted. Think about, we couldn't travel, we couldn't go to cinemas, we couldn't go to hotels, we could hardly visit hospitals, and of course, in the case of CSL, it was very difficult to be a blood donor, particularly in the US. Now they are now in the different reversal. They are now trending towards normal from a positive perspective. Maybe with one exception, Ramsey Healthcare, that trajectory towards normalization is much more difficult than they themselves had forecast, I think. But obviously, needless to say, one of the drivers behind renewed optimism for CSL is the fact that they can now have all their centers open again, and everyone can walk in and donate. The danger we have in Australia, and it's one of the reasons why I have been saying to people, don't be afraid to have enough cash on the sidelines, and don't be too positive about what's coming next, is that we have a larger than usual so-called second half club on the stock exchange. And what do I mean by that? Is that in February there was a large number of companies, and it happens every February, that doesn't meet their own guidance or expectations at the half-year level, but they tell investors, don't worry, we'll make up for it in the second half. And that's fine, but because in many cases they can. But it becomes more difficult when that second half is now coinciding with lesser momentum and more hurdles in the economy, which basically means it becomes more difficult, and then we should expect more profit warnings, more companies having to admit that yes, we said in February we might make up for it, but maybe we won't, and we can't. And one of the examples we saw in the past few days is, for example, is baby bunting, with obviously with disastrous again quite heavy impact on the share price. But in general, what we're seeing in Australia, and don't underestimate, we usually have about, let's say, a quarter of companies, maybe a quarter of companies that make up the so-called second half club. This time around, we have about 48% of companies that reported in February. So it's a very large club now, and this will explain why I think we should all expect a lot more and have a true confession season this year. Consumer spending is, of course, a problem. Smaller cap companies are more vulnerable than larger caps. That's how these things work. And the main problems are often still situated in finding staff, keeping them, and other input costs. But this is one of the dynamics that that is determining share prices underneath the surface, let's say. Another thing that happened this year, and I'm actually I always feel privileged that I can be so close on markets, and I can be so close on these new developments taking place. I'm very happy that I can again I can be researching, analyzing, and making predictions and observations about something that is going to change the future, essentially. And I know everyone is getting a little bit hot under the collar in the US. Share prices are up by 100% and more. It's all about artificial intelligence, of course. don't be put away by it. It's the initial response. I was there when internet came and we all got excited, and but the internet has changed life, and artificial intelligence is going to change life. And we will have winners and losers. It's going to take years to develop. It's probably going to have a full decade of impact on economies and on companies. Now is the time to start looking into it. I think we have time on our side. It's not a process that's going to happen overnight, but it has started. And the initial phase is always that we get enormous exuberance in a small collection of stocks that happens to be directly related to AI, but it'll become a much wider phenomenon. I mean, it's a little bit silly to say that all companies become tech companies. Because companies are on the internet today, it doesn't mean they're internet companies or .com companies, but all companies will be forced to look into AI and to make investments in it. Now, there's 3 levels where this new phenomenon is going to impact on companies. And I already said, they will have to make investments, and they will have to make a lot of investments in it. In a positive scenario, for a lot of companies, it will increase the revenues, the sales. For a lot of companies, and probably for most, it will lower the costs. But there's also a threat there. It will increase competition in many sectors. And in a bad case scenario, this last element can negate the benefits from the 2 previous ones, of course. Now, we're at a very early stage, and we have made some forecasts that I've put a few sectors here that at this point in time look like they might become the major beneficiaries, like medical devices, telecoms, even real estate and mining, capital goods, retail. But equally important, there are some sectors that might not be that much on the beneficiary side, also because of the competition, and maybe they don't get that much added in the sales. And we have to think about the financials, banks, insurers, wealth managers, payment processors, etc. Transport, building and construction, IT and support services, and automobiles. Anyway, food for thought. Definitely make sure this remains on your agenda. And I'm convinced that this is the seed of the next bull market we will see in equities. This will be something that will give a new boost to economies, but it will not happen immediately and in a very short time. But it will become increasingly a factor in the share market. What else should you put in your portfolio? That's an interesting question. Even from last year onwards already, because strategists, analysts, stock pickers, they have to look forward. And those who ignored the elements that were temporarily having a good time, the mining stocks and the energy stocks, and there were times when the banks were actually rallying, they started looking forward to what was coming. And what is coming is inevitably an impact on economic growth, on economic momentum. So they started looking for companies that are less impacted by that. So we're looking for predictable growth, stable margins, low debt, plenty of cash flow. And essentially what you're looking for is for sturdy, defensive, reliable, quality companies that are less likely having to issue a profit warning or to cut their dividends. And essentially that is all being summarized under the label of quality. I'm not too unhappy about this, because I sort of make a living out of trying to detect these companies. And so you can also throw in the structural growth companies, of course, and the long duration companies. And it shouldn't be no secret. Even in Australia, the companies that have made a comeback this year after having had a bad time last year, it includes the likes of Car Sales and REA Group, CSL, Technology One, WiseTech Global. They all fall under this label, right? And it may well be that outperformance that lasts for longer, depending on how bad it actually gets in terms of economic growth and the loss of economic momentum, and how far central bankers have to go in cutting their interest rate, or well, raising their interest rate at this point in time. Having said all this, we sort of, I hope I've sort of given you a quick rundown into what we've been through, what is likely to happen, and the few things that, at the very least, where my attention is focused on, and where I think your attention should be focused on as well. Again, nothing lasts forever, but for the moment, I think this is the context in which we operate. Since it's actually now it's actually almost now 9 years now, I've been running a portfolio, my own one. It does focus on the quality end of the market. If anyone wants to have any questions, by all means, I will try to answer them. The other thing is that if you like what I do in terms of my research and the presentations I do, I, on a regular basis, curate a secret report at FN Arena. It's very simple to access it. You type the web address fnarena.com/secret in your browser, and that should give you an access to the report. I've just updated it last week. It definitely, I would say, contains, at the very least, one or multiple stories that every investor should read and think about. And I think I've sort of succeeded in keeping it within the time frame, and I am open for Q&A now. I hope you liked it, guys.